Hey everyone, well, buckle up because we've got some big news. The Consumer Price Index is about to make its grand entrance into the markets, and we've got the latest insights from JP Morgan, and we're covering our key levels moving forward, depending on, of course, the result. We'll be giving you a rundown of this major news event, and it's sure to shake things up in 2023. Will the bulls take full control of this market and start pushing our narrative of the next extreme zone? Or is everything about to start crashing? Grab a coffee and let's dive in. Well, welcome back everyone to The Daily Show. We're talking about stocks, commodities, and cryptos today. We've got the macro, the news, the lead indicators, and the key levels that you need to be watching into this massive news event. So why is this CPI report such a big deal? Well, a lot of it has to do with where the market's at. We know the markets have been on a rocket ship through January as yields have technically decreased most of the time, and it's led us to this point. It's led us to a point where the market is at extreme zones, ready to either break out and give us some amazing new results or get crushed, and maybe even a crash to start in these markets. So why are we bringing up this report? Well, I wanted to really highlight one of the comments down here, and this is from the Federal Reserve of Cleveland's Inflation Nowcast. Now, it's predicting a hotter than consensus CPI report. As of Monday, the Cleveland's Fed model showed CPI to rise 0.65% month over month, or 6.5% on a yearly basis. Now, that's going to be in a reading that most people don't expect. So, of course, the markets would fall heavily, well, at least it's predicted they'll fall heavily if a number like that comes out. For core CPI, the tracker estimates 0.46 monthly increase or a 5.6 year-over-year advance. Now, the model have a little bit mixed record of late, but it's generally good at calling inflation trends. So this will be a very interesting fact. Now, why did the market go up on the Monday session? Well, a lot of it's got to do with this idea of private sector wages decreasing and that basically front-loading core services inflation. That's a partial. I think it's setting up at a nice equilibrium point though, however, and we'll discuss that when we look at the charts for the next extreme move, the liquidity grabs that could occur during this inflation report. That tends to be the way I like to look at markets, and we'll check that out later on. So what about JP Morgan? We mentioned them at the beginning. What is their game plan CPI day? Well, they believe that it's not really possible to get the 6.5%. Only 5% probability, 6.4 to 6.5, 25% probability. And these are their game plans based on those numbers. Now, of course, you have to take it partially with a grain of salt, but it's interesting that they're basically estimating 65% of the time will fall between 6 and 6.3. And that in that case, the market would go up 1.5 to 2. So we'll actually plot that out a little bit later on the charts because I do think it's important. Two other bits of information that we've shared over on our Twitter, follow at FX Evolution, links in the description if you're interested, have been the rise of the retail trader. We know we're sitting between 23 and 25% of market traffic at the moment. That's pretty incredible. We do need to be concerned about the options market. A few people in our live streams, which we run every Monday for the Monday Open, if you're interested in following us, then we have been talking about options being the one thing we really need to watch. It's probably giving retail traders the largest edge in the markets when trying to think contrarian about what's going on. In August, we saw calls. This is call option buys minus sells for the open with less than 10 contracts coming out, hit similar records. Now, that has us a little bit worried because even if we start pushing a new narrative, let's say we go to 4,300 plus, which is our next level if the markets do break out of this 4,200 zone, so we're talking 4,350 most likely. If this continues to rise, you have to get more and more concerned because it will most likely tip over. This is something that we've seen before, and every other time it has tipped over when retail gets that bullish. Here's net call volume, mega cap growth, and tech stocks within the S&P 500. And you might say, well, that could be anyone buying those. Well, the problem is if we scroll down here, you can see that retail has been dominating these stocks. Tesla, Amazon, Apple, Meta, AMD, Nvidia, just to name a few. My favorite, Microsoft down there. These are the ones that realistically all the retail traders have been buying, and rightfully so, the quality companies. But look at that Tesla one. That's got the biggest amount of potential manipulation on it. It's almost 5 times more throughput traffic than any other stock out there on the markets. It's pretty incredible. Everyone's been chasing the AI dreams at the moment. We will update this, of course, report as we see the CPI numbers come out. So make sure to stay tuned for this. Basically, this tells us the future of what the market expects. Where is the Fed terminal rate getting? That's the highest rate. How many cuts are they going to have to produce? How fast is the cuts going to happen? And then where are they going to end in terms of their cuts to get the economy back on track? There will be cuts coming in the future. The market knows this. But I do think there are some risks not taken into account for this market. So I want to discuss that. Firstly, positioning from the big players. It's relatively neutral. The market players have built positions to allow, in case it rallies, them to make some money, but they're not super heavily in. We usually see them absolutely commit if they're going to. At this stage, they're waiting, I believe, for the CPI to come out to make their next choice. But yes, there are mutual fund monies sitting on the side. A lot of people have been talking about it, and a lot of it hasn't been put in markets. So you do need to consider that. If markets start to rally again, potentially some insane things could occur during the first quarter and quarter two. However, we are not there yet, so we'll have to talk about that should it happen. Now, should we be bewaring here? Well, remember, ChatGPT said that the markets would crash on the 15th of Feb. So that's pretty funny because, of course, we're coming into a interesting point. 15th of Feb also turns out to be the data point from the 1950s to now, where technically February starts to turn negative. Now, this is just data, but it does hold up over a long period of time. So if we're stacking that with maybe a little bit too much retail getting hyper and maybe a poor or neutralized CPI, it does potentially give the market the go-ahead to go down. Here's the VIX, the volatility seasonality. Now, you'll notice that middle of Feb, what occurs? We tend to see a spiking in the VIX. In fact, it tends to be actually the highest VIX spike taken over history. This is a 20-year range in terms of big rejections. Now, it has been helped a little bit since 2020 in terms of the stats here. But you'll notice there's two periods, Q1 and Q3, that tend to be VIX spike periods. These are the negative data, kind of like basically market seasonalities that you do want to know about. And if you see them on the charts, you need to be paying attention. I also think that this is never understated. This is the idea that the Fed will eventually hit a terminal rate. Markets often rise into those levels, which is what's happening right now. So it shouldn't be technically fully unexpected. And then as we flatline through the terminal rate, that's when you need to be concerned. Remember, the Fed is not going to cut rates because it thinks, oh, the economy is so great. Look how great everything is. Earnings will be suffering. The economy will be suffering. Now, whether this happens later on in 2023, we don't know that. But be aware of it. Keep it in the back of your mind and make sure, even if you take snapshots of it, look at those types of things because it's going to be important. Here is median when inverted versus not inverted. For any new people, you haven't seen this before. For everybody else, yes, I know I'm talking it to death. It's because I do think it's a really important concept. The markets go sideways to up leading into the inversion. Then after that, we tend to go down when they start cutting. So you've just got to remember, we are so heavily inverted. The bonds market's telling us there's a sickness. It just takes a long time to show itself. So you've got to remember, keep that in the back of your mind if these markets start to rally and you start to feel FOMO on your investments and all types of things. It doesn't mean you can't buy things and get into it, but you do need to keep in mind the risks on both sides. So this week is all about hypergrowths. There's hypergrowths everywhere. These are the implied expected moves. These are the options expected moves. Of course, the biggest move is expected to come from Twilio. Roku's up there as well. Roblox, Shop, Dash, DDog. Some very popular retail companies. However, we'll find out whether they actually do have those massive implied vols. Options traders will be getting wild on those ones. What about for the Monday trade? Did we see the markets go defensive for another day? We saw defensives middle of the pack. So that's XLP, XLV, and XLU. There wasn't any, at the start of the day, there was a bit of defensive play. You can see the XLPs kind of coming out fairly strong at the session. But as the market went through, and we did definitely think this, that the market would go bullish on the session. And it certainly did. Here's the 5-day. Again, XLV, at least it's through the top end. And this is the best results we've actually seen from defensives for the whole entirety of 2023. They're not absolutely out in front, but they're seeing some rotational into them. So clearly there's a few bigger players that are setting up potentially some risk-averse kind of plays, trying to say, okay, well, I am looking forward to basically not going into this CPI unprepared. I'm going to take some defensives, and they are doing it. They're just not doing it en masse like you usually like to see. Well, just before we jump into the charts and we look at all the key levels that you need to be watching ahead of this CPI number, I want to say a big thank you to the sponsor of today's video, which is Tiger Brokers. Now, why are we bringing this up? Well, there's some things that I wanted to discuss, especially around such key economic news. See, the problem with news such as CPI is, when does it come out? Well, it comes out 1 hour before the market opens. Well, that's a problem if you're trading normal markets. You don't have the ability to react to it. Now, of course, I say patience, react, don't predict. Often their best trades are entered after the news comes out. It goes in the wrong direction. Often it grabs liquidity. And then, of course, it goes off in the opposite direction. Now, you need a broker that allows you to potentially trade those markets. Well, the great thing, especially for the Australian viewers out there, is Tiger Brokers has, I believe, the most amount of post-market and pre-market hours for the key stocks, 16 hours in total. So 16 of 24 hours a day, you can trade the markets. Now, remember, that's not normal in terms of what we've got going on with normal market conditions. You can only usually open it during the session itself. So between 6 p.m. and 10 a.m. Australian Eastern domestic time, you're able to actually trade these stocks. But it doesn't really stop right there. I mean, obviously, some of the best stocks, and there is a reason we love the US markets, is that you can trade stocks like Apple, Tesla, Microsoft, and many others. But some might be too expensive for you. You know, Microsoft is 271 American dollars. That's a lot of Australian dollars. You know, that's too many Australian dollars for some people out there. So Tiger Brokers often look at these problems and they say, how can we fix it? And of course, fractional share trading was one of the fixes to allow people with smaller accounts to own some of the best companies in the world. So not only can you trade outside of normal hours, but also Tiger Brokers have fractional share trading. These are both huge benefits. They offer a whole bunch of markets. Make sure to check them out. Links in the description. A whole bunch of countries out there with special offers as well that we've managed to organize for you, the community that supports this channel. So check them out today. So let's now jump into the charts and, of course, the big zones that we need to be talking about, because this is an exciting event. The VIX is not doing much leading into this, so we'll leave that on the charts. It's above 20. Yeah, okay, whatever VIX, it's doing its thing. But this is where I think the biggest battles will be fought over the next 24 hours, and it has to do with yield. So here we have basically the Fed terminal rate. This is September of this year, of 2023, and the forward projected terminal rate of the Fed. Now, where is it? Extreme zone. So we're sitting at 5.18%, 5.2 being the highest ever. If this busts through, the market's not going to like it. The market will probably sell tech in general. And that's because, of course, technology doesn't like higher yields for longer. So watch this, put these codes into your TradingView platform or whichever platform you can do it, and make sure to check them out. What about bonds? What have bonds been telling us over the last 24 hours? Well, they had some recovery. TLT getting down into that nice level. In fact, if you actually put like a fib on this from that last pull, you'll notice it's kind of at that 61.8. It's a decent zone. Now, I've said for a long time that if you believe we're in some kind of deflationary bust, basically, let's call it a crash style scenario or recession style scenario in the US, theoretically, most people go to treasuries. Now, you have to believe, though, inflation's over. So that is, inflation's on the decline and yields are on the decline. These are very sensitive to long-term yields. So you've got to be making sure that you pay that attention. But TLT at a fair zone inside of our range at this stage. What about one of our canaries of 2022? This was a canary that kicked off many of the worst kind of market sell-offs in 2022. Well, again, HYG, which is basically junk bonds, has started to say there's weakness here. Now, what I've done is I've overlaid it with the SPX. So you can see that the S&P 500 is kind of getting hyperactive and the bonds are not getting hyperactive. Now, a lot of it's got to do with yields, but that's becoming a bit of a divergence. Now, when did we see this last time? Over here. And then the inflation number over here was the kryptonite for the stock market and sent it down. I mean, ultimately, it comes down to the numbers at this stage, but certainly something to be paying attention to. Dollar index stayed exactly where we thought it would. The US dollar stuck within a range and it sold off these highs. It's coiling. Is it distribution and the market's going to move down, or is it accumulation and the market's going to move up? We will find out, I'm sure, within 24 hours. But at the moment, the market has been mostly bullish. And if we do breach out, we're talking about extreme zones. So what I want to say was, if the markets do breach zones or areas, they tend to move to the next level of equilibrium. And that tends to be how you have to set up ahead of these news events. No one really will know the CPI number. You can model it, you can guess it, you can use other things. But let's face it, Wall Street have the algorithms that probably allow them to do it better, faster, and more efficiently. So then the question becomes, if you breach this level and close, where do you go? Well, I've highlighted two zones that I think are pretty critical in the markets moving forward. The first one is the technical level of about 105.25. Now, if the market comes in hot on CPI or just even average and the markets decide to sell off and in general yields start to overall rise a little bit, then this is what the US dollar would most likely do. And if you're looking at it on the surface, yes, it's rejected, but it's got probably more wicks on the bottom end. So you'd say there's maybe some positioning towards strong dollar at this point. If it does, we move maybe to 105.25. That's going to be the next big resistance or supply zone. Now, if the market comes in, let's call it soft, and US dollar starts to weaken because yields start dropping off a cliff, making it less desirable, the next zone that I think it could go to is around that 101.72. So pretty extreme wide zones, because I think those are the key levels for the US dollar moving forward. And I've done some thinking about this. I think those are some of the best ones. What about gold? Well, it's going to move in conjunction with the US dollar, but in general, the rule that I would go with, and I think a rule that not enough people talk about, is again, if yields start to drop further and basically inflation drops, then you probably will see gold do pretty well. But if yields have a higher for longer or less cut kind of forward projection after the CPI, gold will hate it. So it's found itself at a critical zone. You could make an argument this is in a downtrend at the moment. Flag, rejection. It's made a new low over the last 24 hours. If it breaches this area here of 1870, I'm thinking it's probably going to go towards bullish side. And I've got 1920 kind of as a critical extreme zone and 1800 as an extreme zone. So I think both of those levels could be the next points of equilibrium for gold. What about copper? I've been negative on this for weeks, and I think all of us have been, because it hit the critical zones. We talked about the key level, we stacked it up, and now we find ourselves at either a double bottom that could be moving towards upside, or of course, a range-bound market that could be moving towards the downside. You could literally argue both cases here very, very well, by the way. You could argue both of them. So which side's copper going on? Well, of course, I'm leaning into the negative side, but you're going to have, of course, bad inflation. So we'll find out what happens there. And here we move on to oil. Now, oil's really tough because you've got government, you've got inflation, you've got CPI coming out. This will move quite a lot, I'm pretty sure. Again, very sensitive to yields at the moment, but it's trapped within two zones. So you've got kind of an alert that you might want to set above 84, which could push that narrative higher, where you start to move into those 88s. And if we start coming down, look, I still think there's a government kind of purchase or government kind of, let's say, holding level somewhere between 70 and 74. I'm off oil at the moment just because of that. I think it's a little bit too manipulated on the bottom end, which makes it hard. Natural gas starting to look a little bit better. I've set an alert just below here, 2.46, because at the moment we have like a selling climax. We have like an automatic rally. We obviously have a sell-off. I'm looking for a take of the low to freak people out. I say patience in most cases. React, don't predict. You're trying to stop a freight train down. To put it in context for anyone that hasn't seen oil, this is called the Widowmaker for a reason. It's a horror show thing to trade unless you're on the right side of it. It can move 10, 30% even in a day. And you can see what's happened recently. Big downward trend, contrary to what most people believed, which is, of course, winter. Oh, we're going to need the natural gas. It's all good. Well, it didn't happen. And then the markets come down and we're down in these lows. So be very careful here, but we're starting to see the potential of a new base. Let's move over to extreme level 1 and Tesla. So this actually was a pretty weak stock considering everything else that was going on. We ended as a small hammer. We've got our evening star formation that still shows negative. And overall, we're at an extreme level. Now, if the markets come in hot like good and everything starts to get bought up heavily, we probably move towards extreme level number 2. And we've got some set alert here zones. You can also see the expected weekly options high sits on the previous high around that 208. If the market sells off though, which is of course, yeah, I'm going to favor that at the moment based on the options, then where does Tesla go next? Well, I have a suspicion it could come back down to this 61.8 or even fill a gap that we'll talk about in here. Obviously, we'll look into this a lot more once we see the CPI number and we start to see some directional. But yeah, look, I mean, it's a big run. Traditionally, if the markets really want to build strong positions in Tesla, they would allow it to come back down. But obviously, this thing is run by mostly retail, it looks like. This is the one stock you could almost say is retail held and retail loved. What about the options? Well, I've refreshed them here, starting to become pretty heavy on the calls. We've got 800 and almost 20,000 units, all sitting at 220 and 200 predominantly. The current maximum pain level is quite low, so that's kind of pushing that negative narrative coming into this massive third week options expiration period. But yeah, I mean, look, CPI again could destroy this either way. Again, you're going to look at it with the evidence, the weight of evidence. You would think it's negative overall based on the evening star, based on the critical level, based on the options, based on the FOMO, all of those things. CPI could do something weird. What about Apple? Well, it's stuck in the range as well. It hasn't made it past our extreme zone. In terms of liquidity, where's our expected weekly options high? Let's say the markets quickly rally into here. This could be a critical zone for bears to come in and say, no. We don't know which one's going to happen, but these are the key levels to be watching. If the markets dump, where are Apple fanboys and fangirls going to pick it back up? Well, it could be around this 146, 145. So we've got key ranges based on the options and where we think the markets could hold. And also, they seem to be stacking pretty well with the technical zones as well. Nvidia, look, we still have to favor, of course, the negative side, but now we have 2 weeks down, 2 weeks up. So based on trend, you would say up. Based on critical level, I would say down. Based on weight of evidence, which is, of course, the options component, you would have to think over the next month to month and a half, something's going to break and markets may go down. But again, that's a lot of bias on the options side. I try to keep it unbiased as much as possible, but yeah, look, I'm still thinking this watch reaction here. Even the Monday kind of rally, it seems a little bit dodge, and that's something that I think we need to look at when we check out these indices. Metaverse, here it is. It's sitting in between, nothing much to say on that. UK 100 still testing new highs at this stage, so no turnaround. The only level I really care about with the UK 100 is probably this 7710, and until it breaks underneath that and sets my alert off, I'm not too interested in going against this. To give you an idea, this is almost, I think it's like 82 to 88% shorted by retail. So you can see why it's been rallying heavily. The level of CFD shorts, that is future shorts, has been massive throughout that. CQQQ, this is the Chinese, basically Nasdaq. It's still looking weak, nothing much to say there. Could be building a position, but at this stage, it's still at the previous supply. So still at a resistance. And I think some people will be taking profit. What about the Dow? Well, we find ourselves still trapped ahead of CPI in the triangle, so nothing much going on there. And then we've got the Qs here. Now, that's a decent turnaround. We obviously had a gap down, a doji, and then a gap up, and it moves through. But more importantly, if we go and have a look at the smaller timeframes, we can kind of figure out whether we actually got a full fill on our gaps, and we didn't. So if you have a look here, not that this is the real market, obviously it's the Qs. Theoretically, some people believe it's wick to wick, and some people believe that you have to get down to the actual real gap, which is the close. So there's some unfinished business potentially around this level. And I think this is a zone to be watching when the result comes out, just a mini zone. This is what we call a mini zone. We'll look at the big zones on the S&P in a moment. Here's the US 100, breaches through this very key resistance zone, ends up kind of in the middle of nowhere level. If you have a look at it, we liked this area on the weekend video for buyers. Buyers did commit. Now we're saying, well, where are we? Where are we going to find ourselves? Many people will be drawing these types of things, downward channels and trends and all sorts of things. I'm starting to believe there's some interesting little unfinished gaps that are sitting up here. And we've got two extreme zones. I'm going to use the S&P 500 to show them to you. So first up, here's the S&P 500. Here's our general thought processes. The first one is, and make sure you pay attention to this, 397, okay, is a weekly level and also an options level. Okay, so pay attention. There's a technical gap 4018. Okay, so down in these lows. So somewhere in here is definitely where the buyers should theoretically be. Extreme zone number 1 has been hit. We know that we have unfilled gaps above. So if we do end up closing above 4,200 thanks to CPI, there's most likely more ramp to come, which will push this extreme zone number 2 narrative, fill these 2 unfilled gaps, and then the bears are not really allowed to recommit, you would think, until up here. But we also have some technical gaps. So we still have a little gap sitting at 41.63. So here's the close and all of everything that's going on. Now, if we go down to the smaller time frames, let's get a 5-minute up on the charts. Hopefully everyone's following along here. So again, look at this, 40.90. Theoretically, it gapped and didn't fill. It filled to the wicks. It didn't fill to the body. Now, you can argue each way. Of course, some people say fill to the gaps, fill to the wicks. I'm going to say that's partially unfinished. So we've got some kind of key levels that liquidity could grab during the CPI. There's the grab of what we would call the supply above here. Now, we've been negative at the supply recently and the markets have been theoretically going more and more bearish each time because the market went high, made a switch in here, which made us bearish. This was obviously a supply take, took it down, supply take, took it down. Futures got a little bit higher than that. Again, supply take. So anything in here is where the bears sit. So if we get a result and it goes bang, then will there be a reaction like that? So we're looking for critical levels to be hit and then reactions off those critical levels. That's generally the way you want to look at news. Here's the expected weekly options highs. We have seen some pretty wild results in the past, e.g. over here, where markets have hit those expected weekly options highs, instantly rejected at the beginning of the session, and then gone down. So it's possible we could instantly rally up here, tap all of this, and if we short off this zone, this becomes very likely a Wyckoff distribution, which we'll talk about. Again, this is why it's so exciting. There's so many parameters that we can think of. Weekly options high, weekly options low. Remember I said 397? Look where the weekly options low is, 396. So if markets start to sell off, where are the buyers potentially going to recommit? Maybe somewhere around here. Let's look at the US 500 to kind of continue with this thought process. And I've dropped that one, so I'll just quickly remove it. So we've got technical gaps here and here. This is the 40-20 zones and the 41.63s in the level of supply. We have the potential of some reaction through here, including that extreme 4,200 rejection where bears are going to recommit. We know that we've got a small gap sitting in here, somewhere in there, which is left from the Monday open. So again, some reactional zones. We've got the 40-20 and then we've got the 397. And the two extremes would be the one up here and the one down here. So if I was going to say where are the extreme levels of equilibrium moves, it's probably going to be around 396, 397, and of course these tops into 4,200. They're going to be the key levels that I'm looking at over the next 24 hours. If the market comes out, rams into those levels, and then what does it do there? And that's where the patience comes in. It's very difficult. It's a very fast trade, but some key zones, hopefully it does help just further clarify some of the big levels that we're looking at for these markets. Let's move over to the options. We'll refresh it together. Now, we do know that this is the third week options expiration. So what does that mean? It means huge amounts of open interest. Let's move over to the 17th here and have a look at the open interest so far. So 375 puts. Yeah, probably not going to get paid, guys, unfortunately. We do have a lot of 400 puts getting opened, and predominantly we have maximum pain sitting on 400. So we're trading at 412. We've got 400. If we move down into 396, 395, 396, 397, you could see the market want to rally that to move ahead of 400 by the end of the week. If the market goes ballistic up, it's still realistically not the best for it to move above 420 because that's not going to make the most amount of money for the big players out there, the big Wall Street players. So yeah, I mean, the reaction again would be ideally to move up and then dump if we got the right CPI result. What about Bitcoin? What's it setting up for? Well, I think it's setting up for a kind of rally and then dump in terms of the critical levels we've seen. We've had this level zone down here, which was broken. The markets are chilling. If the CPI result comes in nice, I wouldn't mind to see it pull this level and then sell off back down to the 20,000. And then, of course, this should kind of equal and highlight really the comparison with the stock market itself. Bitcoin should theoretically be moving partially with it as we see algorithms across the board basically work out new risk rates. So again, Bitcoin starting to look a little bit shaky here on the charts weekly. If you look at the weekly, we obviously rejected this big supply zone. So again, looking shaky. The news will ultimately clean it up. So what is the news? Well, CPI here, 8:30 a.m. New York time. So it's going to be a big one. Yes, they changed the calculation and all that stuff. Look, I don't really have much opinion on it. I just feel like the data should still be the data and people should be able to see through that. We'll find out whether that's the way Wall Street wants to play it. And ultimately, that's the thing that's important. How do they want to play it? Which way, which extreme are they going to hit? Core retail sales coming Wednesday, February 15th, 8:30 a.m. And then we scroll down here and we've got core PPI and PPI coming out 8:30 a.m. Thursday, February 16th. So it's an action-packed week from lots of hyper stocks, lots of implied volatility, extreme event risk. Remember, those options are so wide for a reason. They're so wide because that's what the expectation of the market is in terms of how much implied volatility is out there in these markets right now. If you enjoyed today's show, make sure to follow us on some of the socials, links in the description down below. Also, check out Tiger Brokers. The links are down there if you're interested in the special offers. And thanks so much for watching as per usual. We'll see you after the CPI result. I'm excited to see what happens here because, of course, it should set us up for at least some kind of trend. It's been painful sitting in this sideways market for the S&P. Now, I know, of course, it hasn't been painful for people YOLOing those Teslas and NVIDIAs, but it has been sideways for a little while now. Hopefully, we're building a position and we're about to find out which way Wall Street wants to push it. Thanks so much. We'll check you in the next video. Bye for now.